Oil prices sliding today on concerns over demand disruption. Shanghai issuing new lockdowns due to a rise in COVID-19 cases. The oil price dip may ease inflation fears in the market, at least temporarily. But does it also mean an economic slowdown could be coming? Let's bring in Tony Dwyer, Canaccord Genuity's chief market strategist. Tony, great to see you. It's been a while. You say the markets are like scaredy cats. I mean, those are my words. But they're overestimating certain fears at this point.
Well, Mel, I think the biggest fear that it's overestimating at this point is the 210 flattening, or the 5-year to 30-year. And I understand why we use that. It is very useful at times. But I think the most important thing we can talk about is, why do we use the yield curve? Because it measures the difference between what a bank or lending institution gets its money at, what they have to pay, versus what they charge or invest it at. That spread is how much money they make. So the real thrust of the banks or lending institutions' liquidity has come from deposits. So since February of 2020, there's been actually $4.75 trillion put into commercial bank deposits. So we're using the 3-month and 5-year. The average duration, according to the Barclays Aggregate Index, is about 6.5 years. So we're measuring what the banks are getting their money at, the deposit rate, 3-month, versus what they're lending it or investing it at, and that's steepened. So the fear is definitely there. Asia seems to be a mess with more lockdowns. Europe is heading toward a recession, if not in one, because of the once-in-a-generation ground war there. And the U.S. is being affected by higher rates. So certainly it's slowing down, but we don't look for a recession because that yield curve that's driving the lending is still very positive.
Tony, it's Karen. Thanks for coming on. Do you think that, how do you think the yield curve will change depending on what the Fed does? If we see 50, let's say, the next 2 meetings, is this already priced in? Is it not? What do you think?
I think it's priced in, right? At this point, everybody's talking about so many rate hikes. Karen, when we look back at the only time that there's been this divergence that I can find, this kind of divergence in the 210 yield curve versus the 3-month, 5-year yield curve, was 1994, when Alan Greenspan was so fearful of inflation that they hiked rates 7 times in a row. 2 of them were 50 basis points, and then there was a 75. They doubled rates. The market acted similarly in that you had a 10% crunch in the beginning of the year, a lot of choppiness around the end of the first quarter, rallied into August almost to a new high, and then that slower economic backdrop hit it again toward December, so it retested the low, and then you didn't look back for 4 years. So I think we're in this environment. We've called it tumultuous. There's no question. Inflation's high. Rates are going higher. The Fed's in a box. No matter the slowdown, they've got to raise rates.
So, Tony, it's Steve. Good to be with you. So when you look at this, I used to remember you saying that whatever du jour rate inversion that you're looking at, it only signaled a recession maybe 18 to 24 months later, and the market usually moves up about 15% between then and the actual recession. Recessions are normal, healthy, and natural, your words. When you look at what Chairman Powell is doing right now, do you think he is just being extremely hawkish with his rhetoric, and where the balance sheet reductions is actually going to be another rate hike, so that he's front loading so the market can catch up, and the back end of this, he's going to come out and be a lot more dovish than his rhetoric would assume?
Well, I think that's going to ultimately be the case, Steve, because the Fed's in a box. They have 2 mandates, inflation and employment. There's no world in the next couple of months where they get better in terms of inflation. So the Fed is looking at this data. Remember, the data can change and the Fed can change pretty quickly. Just remember 5 months ago, not 5 years ago, 5 months ago, the Fed said that there will be a very long lag between when they stop adding to the balance sheet and when they do the initial rate hike. Well, unless that means 5 minutes, that changed. So 5 months from now, it's hard to say that your scenario, Steve, doesn't play itself out. For now, the Fed has to sound hawkish. They have to control inflation expectations, which were well anchored until a few weeks ago. What I find interesting is going back to Mel's comments and what you guys were talking about earlier, the market seems to be almost pricing in a recession trade, because the areas that should do the best with higher rates have been lagging, and the areas that are doing that should do the worst, the FANG stocks, the mega cap valuation names, they're doing better. It's interesting. If you look at the New York FANG index, I was looking at this on Bloomberg today, the 10-day rate of change has never been higher on the FANG index, outperforming the S&P 500. That's in a higher rate environment. That tells me the market's beginning, going back to Karen's point, it's beginning to potentially price in some form of a recession. That's what happens in this kind of transition of monetary policy and economic activity.
Tony, great to see you. Thanks.
Thanks, Mel.
Tony Dwyer, Canaccord. Mike, is that the message of the markets in your view?
Well, I would say that at any point of uncertainty, one of the things that you should be looking for is idiosyncratic growth. You know, the tech names have represented that. I don't know about names like Netflix necessarily, which is part of FANG, but the G in there is definitely appealing to me. You know, Alphabet, I don't see any reason why people aren't piling into that. I mean, I think that's still down. As I looked at today's close, I think it's off maybe 150 basis points on the year, and Amazon just ticked into the green. But, you know, to me, of those two, I would much favor being in Alphabet. I mean, you know, if you're thinking to yourself, what do I want to be in? At a market multiple, how about solid and idiosyncratic growth? And that's what it represents.
Yeah, I agree on that. And I own Google. I also think Netflix at a 0.9 PEG ratio, again, that's price to earnings growth, is the same price really as Google. It's actually particularly cheap. And I also think that we're now back to down 5% off the all-time highs in the middle of an aggressive Fed hike. And I think markets have climbed that wall of worry. I think there's a lot what's going on. We all know where sentiment was 3 weeks ago. We all know that we've now moved 12% higher on NASDAQ stocks. So the question is, we always get a multiple correction in a tightening cycle, typically 2 turns or more. We certainly had gotten that as of where we were a few weeks ago. I do think you're in a case, and there's a chart out there, I don't know if we have it out there, but Goldman had a report talking about buyback activity. And again, in an environment where you have less opportunity for growth or companies that actually are concerned about the volatility in the environment, they are buying back stocks. Goldman says they're going to buy back $319 billion in stocks this year, which would be an all-time record.